Good day, fellow investors! A year ago I made this video on how to calculate intrinsic value. It got more than 116,000 views and thousands of you subscribed to this channel thanks to that video and the free intrinsic value table, comparative table and template that came along. In this video I want to discuss in detail, thanks to also your feedback on the template, the steps to calculate for yourself intrinsic value, one by one, discussed in detail, and also with 5 stocks examples: Alibaba, Apple, Berkshire, Verizon, and the S&P 500 as an index. We're going to calculate the intrinsic value of all, see the correct inputs, and then in 10 steps, by the end of the video, you should be able to calculate intrinsic value for whatever investing opportunity will come to you for your lifetime. I say again, this template has a free download. You just go to my stock market research platform. There is a direct link for this. You can go to check the curriculum here below, and here you have the comparative list of publicly analyzed stocks. So it is on preview, and just scroll. This will be a new report. You can read it as you watch the video in detail following this video, and you can download here for free. I'm not even asking for your email, so you can download this for free there. So just a little bit on me. I have a PhD in a model that I made for stock market risk analysis, investing risk analysis. I have been a professor of finance and accounting at the Amsterdam International School of Business, data researcher for Bloomberg in the past, and since 2018 I'm a fully independent researcher slash investor where I run my stock market research platform. So I'm not a YouTuber, I'm a researcher, and you can check my stock market research platform if you're interested in my in-depth analysis and research. As I said, I'm not a YouTuber, so I do free, maybe 4 videos per month. So please, if you get value from this, smash that like button. It really helps the channel. And also subscribe and click that notification bell if you haven't, to get notified when a new rare video comes out compared to all other YouTubers. So let's immediately start to explain this, and let's start immediately with the intrinsic value definition. There is one person that explains it even better than me.
Well, intrinsic value is the number that if you were all knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is.
Thanks, Warren. There is the link to the video of his explanation in detail here in the card, and should be down in the description below too. And there are a few concepts that are really emphasized by Warren Buffett when it comes to intrinsic value investing and calculating. And the key concepts are that the only reason to make an investing is laying out money now to get more later. Thus, you are aiming for an investment return. How much are you going to get? When are you going to get it? And how sure are you that you're going to get it? Those are all factors that have to be included in the intrinsic value calculation. Then he prefers to look at the business as he's buying the whole business, even if he's buying just a piece of it. That's key. Having an ownership mentality, we'll discuss that too, and how to approach it when you make a valuation. And then the key, of course, invest in businesses, don't speculate on stocks. Before we start with the steps, of course, intrinsic value assumes estimating something in the future. Whatever you think about the future, you will be definitely wrong. But we are not estimating the future. We are looking at the current information we have about the future, putting that in perspective with the market's opinion on that, the market's price, and then seeing whether the risk and reward of the investment is positive for us. So if we can put money out now to get more in the future. The goal is always to minimize risk and maximize reward. And this exercise, calculating the intrinsic value in the form that we'll do it, really helps a lot and makes investing in businesses much easier. And the goal is really to compare investing opportunities to find the best vehicles that most surely lead to your investing goals. So that's intrinsic value, gives a lot of value. Let's start with step by step that I really think should give you much values. And I reiterate myself, smash that like button and share with fellow investors that still need something to understand what investing really is. This template will really be helpful. Step number 1 is the input metric. So what input, earnings per share, revenue, free cash flows, dividends, will we put in the first bracket up there so that it then has repercussions over the whole template, over whole 10 steps. And when you think of a business, when you think of what describes better the business, that's your input. So some businesses have earnings that are better describing them. Some businesses have dividends, some businesses have revenue, but whatever you use, the end result should be pretty similar because then the other steps are different. So if we go to our example immediately, if we go to Apple, Apple is a cash machine still growing with a buyback focus. So when it comes to inputs, cash flow per share, because they have a buyback focus that we'll discuss in a moment. Berkshire, financial fortress, always focused on earnings, compounding those earnings as it's doing buybacks and impacting not the total numbers but per share numbers. Perhaps even better to use earnings per share. Alibaba, it's an ecosystem creator, a business where profits are temporarily secondary, but you must use something. S&P 500, that's simple, earnings or dividends, whatever you use should be okay. And Verizon is really simple because it's a dividend stock. So if we go to our template that you can easily download, let's do this for the S&P 500 here as an example. If you Google S&P 500 dividend in points, you will get this number. If you Google S&P 500 earnings in points, you will get the earnings per S&P 500 share. I have estimated 3% of inflation, 2% growth rate for the dividend alongside, let's say, recessions when the growth might be 0, a little bit faster in really good years. So this is an average over time. A discount rate of 10%, which is my required return on investment, we'll discuss that later. A dividend yield of 2% on the dividend also in 2031, and the intrinsic value of the S&P 500 is much lower than the current value, but we'll discuss more about that in detail. And Berkshire, I have used earnings per share, and here the thing is a little bit detailed because earnings with Berkshire are a little bit delicate. We'll go more into depth in just a moment, but before, let's discuss other feedbacks that I received on this template that are very important. The first one is whether to use per share or total market capitalization metrics, and my answer is very simple. Warren Buffett says that you need to own a business, thus have a total market perspective. So Apple, 2 trillion, that's what it would cost me to buy the whole business now, and then you see the value that is doing or not. But as Apple is doing a lot of buybacks, so financially also engineering the growth in those per share metrics, buybacks don't increase net income, but increase net income per share because the number of shares you divide net income gets smaller and smaller, so there it's better to use per share metrics. Also, if there is dilution, if the company is issuing a lot of new shares, you might also want to use per share metrics. However, wherever I can, I prefer to compare things to market capitalization, so putting total dividend paid in billions or net income in billions and then compare it to the market cap, because it gives me a perspective on where is the company placed in relation to its business market, to the global economy, and it gives you a better feeling of the business and keeps that ownership mentality intact. And then I had another question, many questions about, Sven, how do we estimate the intrinsic value of companies that are not profitable? Now, if company is not profitable and will never be, then the intrinsic value is 0 or below 0, so there's nothing to estimate on value. And I've made a few videos also on stocks that didn't have profits, or those profits are stretched, and especially as I analyzed a little bit the food, the organic sector, I discussed Beyond Meat, I discussed, I think, Very Good Food last year, and also Tattooed Chef, and those are companies that we can't estimate future cash flows. Anything can happen, those stocks can go up 5 times, but most of those stocks will go down 90, 80, 90%, like we have seen with Very Good Food. Because the business model is very, very uncertain, and it's a bet on something getting traction here and there, making money, spending a lot of money to grow with an uncertain result there. Warren Buffett is pretty straightforward with that. He says, if the cash flows cannot be calculated or estimated, if it's just a bet, better stay away from that and compound where you can understand the future cash flows and profits. He's absolutely not interested in growth stocks that just give promises, in turnarounds, in whatever. So it's about knowing the business as good as you can. Alright, let's go to the examples of the input measures to put into our template. Now, as we said, Alibaba is a stock, a business focused on building an ecosystem, and there is no real measure for that. But the company focuses on net income and free cash flows, so why not focus on what the business offers? 172 billion renminbi, that's exactly what I have used in our template here. So Alibaba, cash flows in billions, and that's my input value. The buybacks are there, but not yet significant to change this from cash flow in billions to cash flow per share. Now, when it comes to Apple, as we said, Apple is a cash machine. This is the cash generated in the first 9 months of this fiscal year. I assume it will be more than 100 billion, and if we look at what they spend the cash on, it's a little bit, 13% on dividends, and the rest on repurchases of common stock. So if they pay out 14 billion in dividends and the rest in repurchases of common stock, it will impact the number of shares outstanding, and you can see it going down over time, and therefore I prefer using a per share metric here. So if I go to Apple, you can download this and follow it all, then we can see I used 100 billion, likely be even higher. Let me know in the comments if I got it right, as I'm filming this just before Apple's yearly earnings come out this Wednesday. Now let's go to Berkshire, which is very interesting when it comes to investing, because Berkshire, yes, is focused on earnings, but Warren Buffett has started doing a lot of buybacks, and then there is an accounting issue where Warren Buffett has to show the change in the stock market portfolio into the bottom line, into net income, that skews real earnings. If we look at Berkshire's earnings over the last years, those were pretty stable with the dip during the financial crisis, pretty stable and growing over time. Then a new accounting rule came where Buffett has to show the change in earnings, the change in the portfolio value of the stock market, of the stocks it owns, and that completely skews the earnings perspective there. But thanks to Buffett, he always shows us the real result from operations, so you can deduct the investment and derivative gains and losses from the numbers, sum things up as we did in this last video, plus add the earnings of the portfolio, because only the dividends are reported in Berkshire's earnings. The earnings that are reinvested are not. And Warren Buffett also always says how that's about 8 billion per year. So 28 and 8 billion is about 36 billion that I think Berkshire will make in 2021. We look at the number of shares outstanding. One Class A share equals 1,500 Class B shares, so that's absolutely equal there. And I have divided the 36 billion with the number of shares outstanding and got to $15 per share for Berkshire B. You're also mostly owning Berkshire B, so let's compare that to the stock price. Next one, we have the S&P 500, dividends there. And we have Verizon. Where are you? Here you are. And Verizon is again a dividend stock, so I have simply used the current dividend per share as an input metric. Alright, we have covered step number 1, step number 2, what to choose, how to choose it, and now we go to the next step into calculating intrinsic value. As Buffett said, you have to calculate what's the current value of something happening in the future cash flows that you will receive. For that, you need to understand the concept of present value and how to calculate it. So, present value calculation, this is the formula. So, the future value divided by 1 plus the rate of return, the expected return, and factored by the number of periods. Let's say we'll receive $100 5 years from now, and my expected rate of return is 10%. I put 100, 1 plus 0.1, that's 1.1, factored by 5, and I get the present value of 62. So if you want to get 100 at a 10% interest rate in 5 years, you have to invest 62 now. Of course, when it comes to investing, calculating present value, there is always the discount rate. And academics have done everything possible to complicate this notion for us investors, but I prefer Nassim Taleb, Fat Tony, or grandma style calculations. I don't care what academics think, I care only about my return. How much money do I have to put? How much money will I get? And what's the rate of return there? Anything else is absolutely secondary when it comes to investing, and plus we'll cover that through all the other steps that we are doing. So no need to complicate things by messing with the discount rate. And when it comes to discount rate, for comparative reasons, you'll mostly see me use 10%, and then you can say, okay, what if I change it higher to 15%? You can see, okay, that's the expected return that I will get from a certain business at a certain price if things deliver or develop as projected. In our calculation table, this is all compared on a 10% expected return, so the discount rate is always 10%, and that makes it really, really easy. That makes some investments extremely overvalued, but it is fair because this is what the businesses behind the stock price will deliver, and that's the expected return. Another thing is, okay, when we calculate the present value, we can calculate the yearly present value of each input or not. Some say that you need to calculate the present value of all the earnings. I just calculate the present value if there is some real money that I will get, which is dividends. If not, I don't calculate the present value of each yearly free cash flow, because that free cash flow is usually reinvested, thus will reflect itself into growth, and as I will calculate growth in the next steps, I must not calculate things twice. So with Berkshire reinvests all the earnings. I'm not calculating the present value of each yearly earnings per year because all of that is reinvested and then should increase the growth rate. With Apple, the situation is different. yes, the cash flows are reinvested with buybacks, thus that increases the growth rate, but also 13% of those are given as a dividend, and I calculate the present value of those because those increase the intrinsic value and are actually returned to investors. Then you can also, if you are taxed on dividends, you can also add that here to lower a little bit the present value of the cash flows that you get. And now a question that I got a lot is, Sven, why do you use 10 years of estimations and then a terminal value? Why not 20? Why not 5? Why not 3? Given my 20 years of investing experience, I feel that whatever investing thesis you have, it will likely develop between 1 and 7 years from now. That's how things change, cycles, market. The market thinks in 1-2 years, cannot think longer than 1-2 years. So if you focus on businesses where things develop over 3 years, 2 years, 5 years, then a 10-year period is a pretty good margin of safety that it will cover those business developments. Going longer than 10 years is not really necessary. So I think 7-10 years is the sweet spot for estimation, and that's why I also love using 10 years. It's a little bit stretched, but it, let's say, gives a margin of safety that gives you the time to wait for things to happen. For example, if you looked at Microsoft, the stock went nowhere from 2003 to 2013. However, earnings did double in this period and then doubled, more than doubled since, and sooner or later the stock reflected the business developments. But it can take really time for the market to recognize that, and that's why I also like to get myself a 10-year investing period. It's long term, it covers a few cycles, and then we'll see later also in the scenarios, you can manage that over time, manage your investment and strategy. Step number 5, one of the most important steps, is estimating the growth rate thus over the next 10 years. Now let me tell you immediately, you will be definitely wrong with estimating the growth rate, because it's impossible to predict the future, the economy, wars, whatever will happen. But we are trying to estimate the risk and reward of the business, what the business is offering, and trying to find investment bargains, risk reward, great opportunities. So now, what will happen in the future? Nobody knows, but that's investing. And you try to position yourself so that the upside is unlimited, while the downside is, let's say, managed. Further, you can forget about linearity. We put numbers in a linear way because that makes it easier for estimation, but here you can see the growth in revenues for Apple, and you can see how those are non-linear, and there are also periods where there was no growth. Similarly, Berkshire up and down, and then with new accounting even more crazy. Alibaba growing faster, slowing down, growing again, so all an up and down, and this is really impossible to predict. But this is also the great opportunity that we have, and why we have to estimate long-term growth. Because look at Apple here, 2 periods of slow growth, but then look at what happened when the growth slowed down or there was a decline. The stock went down, I think it was more than 30% in 2015-16. Apple was trading here at a price-earnings ratio of just 10. Yes, 10. Similarly, Apple was again projected by the market to go bankrupt, again 30% down 2018 fourth quarter, because the market always projects the current into eternity. We have to understand that businesses are cyclical, they grow, they slow down, they grow again, and that's why 10 years of estimations create great opportunity to have the conviction to buy these businesses when the market hates or just myopically sees short-term headwinds. Now, how to estimate the growth rate? The better you understand the business, the sector, the better you will estimate the growth rate, the economy, what's going on, what are the forces impacting the business. And to understand that, you read annual reports, you listen to conference calls, because the questions analysts make are really important to see, okay, what is the market sentiment, but also what are the changes in the sector. Competitors, you listen to their conference calls, you read their research reports from government agency and also from private agencies, the McKinseys, etc., that project things, how will evolve, what's the competition, what's this and this. And the more you read, the more you follow over time, you start to understanding the business, and you are more likely to correctly estimate a range of future growth. That's what I do on my research platform, follow more than 30-40 businesses over time, estimate the intrinsic values based on the growth rates, the inputs, the possible scenarios, and then see what's the best investment out there. Now be very careful with listening to management, because all estimations there will be always rosy. So you have to go back 10-20 years, okay, see what can go wrong compared to the management's estimation, and then also estimate that when it comes to investing. Let's go back to our table. Let's discuss the growth rates. So dividend per share, I have put a pretty good growth rate here for Verizon, 5%, and then even 10%, because I expect that the dividend will grow as the capex for 5G subdues, and then they might even lower a little bit the debt. And therefore, this is my estimation. I'm still following Verizon, looking at it, because there might be still 5 years, 4 years of opportunity before the dividend really starts growing. Berkshire, here I might be a little bit conservative, because as they are doing buybacks with yield of 4-5%, add the natural growth of the businesses there, 2-3%, the growth rate might be a little bit conservative at 6%, but there are always economic issues, insurance costs, etc. So let's say just conservatively estimating at 6%, in an exuberant scenario at 8%, in a negative scenario at 5%. Apple, great business, likely growing their ecosystem, their services, so 8% growth rate, 12% in a positive scenario, and 5% in a negative scenario. Based on my estimations, what the business will look like in 10 years, nobody knows, but it's likely it has a great base, and this 8% is also thanks to a lot of buybacks and pretty conservative. S&P 500 likely to grow as the economy grows, and inflation, 3% inflation, 2% economic growth, and there you are, 5% over the long term. Alibaba, it has been growing extremely fast over the last years, so even 40% this year. So I am more conservative, 20% over the next 5 years, even if we might be positively surprised. But even with these, let's say, conservative growth rates, the intrinsic value is staggering if they reach that. Even with lower expected growth rates, the stock would be still a buy for a 10% return. So the better you know a business, the easier it will be for you to estimate the growth rate, to understand the possible outcomes, the scenarios, and that's the best I can say. Read, listen to conference calls, try to know the business over a longer term period to see what the management projects and what's the underlying reality. Also, sometimes you'll see the underlying reality being here, management projecting here, and reality be even higher, and that's a great business to really keep an eye on for a long-term investment opportunity. Alright, now that we have the input, understanding how to calculate the present value, the growth rate, the 10-year period, now we come to the end of the 10-year period, which connects two steps, terminal value and terminal multiple or terminal valuation, to get to that terminal value. The terminal value is the assumed value of the business stock 10 years down the road. We look at the earnings of a year prior to the terminal value year. So in 2031, I don't have 2031 earnings, I have 2030 earnings. I multiply that with the price earnings ratio, the terminal multiple, which gives me the terminal value. So to put it in an example here, I think that Alibaba's cash flows will be 117 billion in 10 years. I have a 20 terminal multiple on the cash flows, and the terminal value is therefore above 2 trillion, 2.3 trillion. So that's Alibaba's terminal value. Perhaps it's easier with the S&P 500. Terminal multiple on the dividend 50. 100 divided by 50 is a dividend yield of 2%. The current dividend yield is much lower than 2%, but let's be conservative here, and I have put it here, the current dividend yield, with a terminal multiple of 75. So the 2030 dividend times 50 gives a value of 4,600 points, thus the S&P 500, on my estimations, will not go anywhere in the next 10 years. And you're lucky if you get this. sorry. This terminal multiple and value really have a big impact on intrinsic value, especially with companies that don't pay dividends. Therefore, it's extremely important to be conservative and to find the margin of safety when putting the inputs there. As I said, you only have the earnings of one earlier year, so you put that into the terminal multiple to get the terminal value and then calculate the present value of that terminal value. The key there is also the terminal multiple, so we are multiplying the input with terminal multiple, and of course, cash flow per share. This is what is the case now with Apple. There is a 30 times cash flow per share valuation, but also just 5 years ago the valuation was 10. So that might change, which represents the risk and reward of investing in a business like Apple. If I go to the S&P 500, if I bring it to a dividend yield, if the market requires a dividend yield of 5%, then the terminal multiple is 20 and the present value of the S&P 500 is 1,000. So that's down 70%. If we look at historical dividend yields, the mean is 4.29%, which is much higher than the current 1.30. If interest rate and things return to the historical mean, then the S&P 500 might crash 40%. That's the risk and reward of investing in an index fund like the S&P 500. That's why I'm not invested in the S&P 500, and I'm also not interested in any index funds at the moment, because the higher terminal multiples here that, let's say, represent the current market situation create also a lot of long-term risks for me, and therefore I prefer to be conservative, looking at, okay, am I happy with a 5% dividend yield? If I'm happy with that, then I should not put more than 1,000 points to buy a S&P 500 index. The message is always be conservative, and then even if in your most conservative scenario the stock is a buy, then you might really, okay, I'm onto something here. And if you get one opportunity like that in a few years, over 10-20 years, you will be very, very well off, not to say rich. Step number 8, scenarios, and also step number 9, which is a scenario, represents a margin of safety to always keep in mind when it comes to investing. Now, I here have scenario 1, scenario 2, best case, scenario 3, worst case scenario. In a best case scenario, I assume higher growth rates, the market being more exuberant, thus a higher terminal multiple, leading to a higher terminal value, leading to a higher present value sum. Also, in a negative scenario, the opposite, lower growth rates, lower terminal multiples, lower present value sums. This is very important because I really think that whatever the business you own, it's very likely that over the next few years, the market will at some point be very exuberant about the business and also very pessimistic about the business. Thus, it will give you those ranges. Whatever stock you look, it goes up and down like crazy. And then that's also another thing why this table is important, to give you, okay, range. Now we are exuberant, thus more risky from an investing perspective, can I check my comparative table? Is there something less risky for similar reward? And by managing risk, you have a better long-term investing performance. And that's why the exuberant scenario is very important. The other scenario, the negative scenario, is also very important because, okay, what can go wrong? What if it goes wrong? What if the market gets negative? What can happen there? And then you think, okay, also for portfolio exposure, this can get uglier and uglier, but I will then wait or buy already and then buy more if it goes uglier. And that gives you, at some point in time when the stock price is below your negative scenario, it gives you a margin of safety. If we go to our table, the only one currently below or at my negative scenario valuation is Alibaba, which makes it for me a buy, and that's why also I own it. Now, something also to discuss is here I put in a probability to get an indicative intrinsic value valuation or price, but I wouldn't say that it is the right thing to do. This is just for indication. Then this gives me an indication of what might be the fair intrinsic, the average intrinsic value, but I always keep in mind the negative potential, the exuberant potential, and then also compare that here into my ratio and then say, okay, let's say this is now getting interesting, this is getting interesting, let's dig deeper, this is getting interesting, let's dig deeper into this, and then understand the specifics, risk and reward, see how it fits my portfolio. And that's why these steps are very, very important, but also take it as a separate step. For example, S&P 500 investors. If the S&P 500 crashes 70%, how does that impact your portfolio, your lifestyle, your finances, your this, your that? Do you survive it or not? If not, then you might reconsider the risk and reward of your complete portfolio. That's why these scenarios are extremely important. And as I said, when the worst case scenario looks okay, you might be onto something. As for the exuberant scenario, you might look at it, see, okay, what's the exuberant value there? What's the outlook? What's the upside? In this case for Alibaba, 4 trillion, that's a 10x. And then it makes you think, okay, should I hold? Should I sell? Should I balance the risk reward or not? And that's also why it's nice to have this. And then, of course, over the 10 years, you adjust the earnings, the cash flows, the outlook based on new long-term impacting business information. And to conclude, step number 10, this is my table that you see here. This is the public version. This you can download for free. On my research platform, there is the premium version with all the stocks, 30-40 stocks that I cover in depth, adjust on earnings. That's what I do as I am a researcher. So if you think you can get value for that, check my research platform. The price is going up. What can I say? Inflation. But if you buy it now, you can lock in the current price forever. And then I compare the values. Then if something is interesting, I look at it. If something gets overvalued, okay, I don't have to look at this or that or something, or just update the valuation of something every few years and then see for good investing opportunities. So let's do a comparison. Let's conclude on our stocks. Berkshire, it's good for a 7% return, which is a great return with the safety Berkshire gives you. It's a financial fortress. It will be there 30-40 years down the road. So that's Berkshire. Berkshire is always Berkshire. And if you're happy with a 6-7% long-term return, Berkshire is definitely a buy. Apple, depending on how you value it, it's also 7% return, likely good growth there, depending also on the terminal multiple the market gives it. So that's the valuation. Maybe you can wait for lower prices, but see how the risk reward fits you. S&P 500 is extremely overvalued in my perspective here, because I want real returns from dividends and earnings, and I don't want to be paying 30, 40, 50 times earnings, or even more, 75 times dividends to get to a return. This is just because the Fed is printing money. If that changes, this will get extremely ugly. And this calculation tells me, okay, you don't have to watch it now. Alibaba, cheap, a bargain in this case, depending on what will happen there. But even in the worst case scenario, I don't think I'll lose money on this one. Of course, talking long term, short term, anything can happen. Verizon, dividend, based on growing dividends in the long term, that would give you a 10% likely return from current levels. And this is the template. Don't forget to check the premium one. If you enjoyed this, smash that like button, share with your friends, with anyone who wants to learn about investing. Don't forget there is also the written report, downloadable for free. You can come back to this video, you can read the report, follow step by step, and I really think I have explained in detail how to calculate intrinsic value. Thank you for watching, looking forward to your comments, and I'll see you in the next video.